Hello there and welcome back. Now, if you're looking to grow your business profitably, you need to be tracking the right metrics. And in this second video, we're going through the second half of the top 10 metrics that you need to really transform your business and grow as profitably as you can. Now, my name's Paul. If you've not met me before, I'm an accountant, I'm a CFO, I'm an entrepreneur, and I've got over 25 years experience of helping businesses to grow profitably. And I've also run several businesses of my own. So believe me when I say I've been in your shoes and know how difficult it can be. Now, before we get into the detail, I'd like you to do me a quick favor and click the subscribe button. I do post new videos every week and I'd hate for you to miss out on any of the content. And secondly, as I said, this is part 2 of a 2-part video. So if you've not seen metrics 1 to 5, do take a look on the channel. They're there. I'll also put a link to them below. It's worth watching those first just to kind of give you a bit of context. These ones they're all relatively simple, but these are perhaps a little bit trickier than the first 5, so you probably want to start off there before we get into the detail. Okay, right, now let's dive on in. So we covered metrics 1 to 5 in the last video. In this video, we're going to be looking at 6 to 10. So let's dive on in. Metric number 6 that you should be tracking is what we call the customer acquisition cost. Now, it's fancy words. Sometimes it's called CAC, sometimes it's called COCA, cost of customer acquisition. All it's really saying is how much does it cost you to get a customer? So it's very simple to calculate. You're going to take your marketing costs, say in the beginning any given month, your marketing spend, say, and then you're going to divide that by the number of new customers that you get in that month, right? Okay, and that's going to give you a figure, say, I don't know, $20 in this example. And it's really important to keep an eye on this. And you'll see I've actually done a whole separate video on how to plan and run profitable marketing campaigns. So worth checking that one out as well, plug. But this is a really interesting metric. So what this is saying in this example, it's costing you $20 to get a customer. So then the next question is, well, how much money how much profit am I making from that customer, and how does this stack up to this? And then you also want to be asking yourself, well, how does this amount vary on a monthly basis? And how does this amount, if you get a little bit more sophisticated, how does this amount vary by different marketing activities? So there could be a scenario whereby you're advertising on Google. Okay, well, that will give you a cost of acquisition. How does that compare with the cost of advertising on Facebook or a social media paid campaign? Or if it's in a shop, you might have like a leaflet campaign, or you might have a particular promotion. Whatever it happens to be to get new people in the door, you want to be measuring this customer acquisition cost and comparing it across different marketing channels, and also seeing how it varies month on month. As I say, flashy name, but a really simple metric that you really need to be keeping an eye on, because actually it's this metric, thinking about it, that can really run away with you. And I've worked with a really an amazing business a few years ago, which was a footwear business, and it was making a fortune. It grew from nothing to multi-million dollars within the space of about 3 years. But then, let's just say the owners decided to sell the business. They took their eye off the ball, and actually their marketing costs started to go up because their marketing was running less efficiently, but they still kept plowing money in every month because they were trying to get a sales number. But actually this cost, and say when it went from this example from $20, $30, $40, $50. So they went from making huge profits to huge losses, literally just because they took their eye off the ball. So it is really important to try and keep an eye on this, because it can run away with you. Okay, that's metric 6. Metric 7, cash generated, and let's see how this generates on a monthly basis. Now, I know you're thinking, well, yeah, obviously, well, I kind of know. Well, I would like to say, do you? Because just to bear in mind, cash is not the same as profit. They can be very, very different. And so if you may well get accounts every month, and you may well be looking at the profit every month, and that's important. I'm not saying it's not important, but cash is what it's all about, because it's cash that we need to pay our bills. So if you haven't got enough cash coming in to cover those bills, you're going to be in trouble. Now, I won't go into huge detail why they're different, but just a couple of things to think about. It's usually timing. You might sell things on credit, so you'll have a sale in this month. You might not get the money for 30 days or 60 days, and so therefore that can cause, your cash generated in that month could be significantly less than the sales you've made. It could be that you've bought a load of stock in and you've had to pay for that stock, or inventory as we call it in the States. You've had to pay for that up front, but actually you're not going to sell it for 6 months. So actually that has a huge impact on the cash generated. So this is why this is a really important metric to look at, okay? It's quite easy to do. You might need someone to help you because it's a bit of a bore, but if you kind of download your bank statement for the month, just look at the net amount of money you got in, ignoring the outs for a minute, and compare that to your profit and your sales rather, you'll really start to see it. So this is something you should focus on every month, as well as profit, okay? It's really, really important. And then connected to that, now we're getting a little bit more detail here. This is something that you will probably need an accountant to help you with, unless you're particularly savvy with numbers, is to calculate your cash runway, right? And your cash runway is how much, this is what I call kind of my buffer, my cash buffer, right? It's basically saying, how much money do I have in the bank and how long will that last me if the sales stop, right? So if I've got in the bank $100,000 as at today, and my running costs each month are $20,000 a month, then I've got a 5-month runway, yeah? So I've got $100,000 in cash, I've got monthly expenses of $20,000, that's going to give me like 5 months. And in an ideal world, this number should be at least 6 months. In an ideal world, a year, but I can tell you no businesses have a year and it's doing very, very well. But this is really a kind of an early warning sign that you might have trouble. So it's why it's good to note in advance. If this starts to get to 1 or 2 months, you need to think, cripes, I need to do something to raise money. So it's really important. So thinking about this, we've kind of looked at the cash in the bank and the fixed costs that we looked at. It's relatively quite straightforward. You can get a little bit more sophisticated with this if you want. One thing I'm very keen on, which we're not going to go into today because it's a can of worms, is building a cash forecast, and that kind of is a much more nuanced way of calculating this. Planning how much cash, what your sales is going to be over the next few months, what the cash coming in is, what your costs going out, and how that varies. Planning that for a few months ahead will give you a much more accurate way of doing it, which might well be very important if your business is new and loss making, and it's really important you know exactly. But if you're not loss making or your cash isn't quite so tight, this higher level way of looking at it is quite helpful. But it is worth focusing on this. I say in general, when it comes to business metrics, most people focus on, should we say, profit metrics as opposed to cash metrics. But as I said, obviously we all know it's cash that pays the bills, not profits. And not enough businesses keep their eye on what's going on with the cash and the cash movements in the business. That's why I had not just 1, but 2 metrics in my key metrics here. Okay, we're going to move on. Actually, the third one I said the third one is kind of connected to cash, but it's slightly different. It's what's called debtor days. Now, if you've not heard this, it's a fancy name for something which is quite straightforward. Now, if you happen to be selling things on credit, I'm not really talking so much about credit cards, because if you've got a business credit card account, you'll kind of get the money in kind of 3 to 5 working days, so it's not a huge lag. But say you've got corporate clients and you're sending them a bill and they pay within 30 days or 60 days or sometimes even longer, then it's really important to be tracking that, because to the point we just made on cash flow, that's an awful lot of money that you're waiting on that you probably need. So what this formula is a way to work out, on average, how long is it taking your credit customers to pay you? That's all that is, okay? It's a really, really simple calculation. we're just going to take so we're only looking at sales on credit. So if you've got sales or revenues from different streams, ignore the ones which aren't on credit, because the whole point of this is to keep an eye on those people who get credit, how quickly they're paying. So you're going to have a look at your your average receivables. In the UK, we call this debtors, hence the name. And then you're going to divide that by your annual credit sales. And you're then going to turn it into days. I just have to stand up here, I'm getting old. Times it by 365. So that's kind of the formula. So if you have, let's work it out. Let's just say you had an average debtor receivable balance of 50k. Let's just say your average sales on credit over a year are 600k. Let's make it easy. Let's make it 500k. Then so that's, and then you're going to times that by 365. What that says on average, your customers are paying you in 36.5 days. So I'm saying it's quite useful to keep an eye on this, because you want to get this number as low as possible. And it's critical because, as I mentioned, most people, when they look at metrics, they look at kind of profit metrics and they don't look at the cash movements. Yeah, I mean, there's a lot more metrics you can look at surrounding this, but this to me is a key one, particularly for businesses. And this is actually quite usually service businesses, because in my experience, a lot of service businesses will do the work and then bill when it's done, and wait a while to get money in the bank. I've got lots of thoughts on how you bill for services, but that's the subject of another video. I have to try and focus here because I do tend to get distracted. Anyway, so that's debtor days. So that's metric number 9. So what have we looked at today? So far we've looked at customer acquisition cost, we've looked at cash generated per month, we've looked at the cash runway, i.e. how much money's worth of expenses do I have in the bank, and then we've looked at debtor days. Actually, quick question, and cash in general, I'd be really keen to find out how many of you actually pay attention to the cash movements in your business, or whether it's something that you don't, or actually whether you just log on and look at your bank very often. Do drop me some comments below. I'd really love to know your thoughts on how you look at cash within your business, and if there's any metrics that you use or any other ways you look at things in your business that you think might be quite helpful for others to know. Do drop them below. I'd really love to read them. Okay, so we've got up to 9. So I promised you a killer metric. And I don't need to roll your eyes at this one because it's quite basic, but I can tell you again, not many people measure it, particularly smaller businesses, okay? My killer metric for today is customer satisfaction. Whoa. Now, I don't mean something which is kind of anecdotal. I mean getting absolute feedback by way of surveys or scores that gives you an idea of how happy your customers are. Why is this? Because customer satisfaction is the key to everything. It's the key to generating repeat business, which is much cheaper than new business. It's the way your business is going to grow. You'll end up with cheaper costs of customer acquisition, marketing costs, because actually people are happier with you and there's word of mouth and people talk to each other. It is the key to everything. If people just come in, are unhappy, they'll buy from you once, you won't see them again, they'll be trashing your reputation. This is the key. And that's not just from a first transaction perspective, that's every time your customer interacts with you, whether that's a pre-sale query, a customer service thing, want to return something, everything. You need to be measuring this, and you need to be asking customers this all the time. Usually just one number, like a score out of 10. How happy are you with how we handled that kind of thing? There's a million apps and tools that you can use for peanuts that will help you track this, but you want as high a score as possible, because this is the key to long-term business success. And I find quite a lot of accountants I've worked with will focus on profit, which is very important, but actually if you don't have this, you won't get that profit in the first place. So this is really the start for me. Okay, right, there we are. That's the second 5 metrics, my top 10 metrics that every business owner needs to know to transform their business and to grow profitably. I hope you found them very helpful. To make things easier, I've actually distilled those into a free fact sheet which you can download below, so you can then take that away, consider them, think about how you can start applying some of these in your business. And with all of these, look, there's a few things here. You don't have to do all these things at once. Just do one today, do one this week. Just start small, make life easy for you, and just start to see the benefit that you get from it, and add more on as you feel comfortable to do so. So download that fact sheet now. And actually, if you do download that fact sheet, I'm also going to send you another free fact sheet about cash flow. Now, we've talked about it a lot today. You'll probably gather it's something I'm very, very passionate about, because I've seen a lot of businesses go bust for not having any money. So what I've done, actually, I've taken in that fact sheet, I guess, the top 10 things that you should be doing or could be doing to turbocharge your cash flow. And it's based on my 25 years of experience. Some of them are incredibly simple, but don't think for a minute that they're not very powerful. So have a look at those as well and start applying those, because you can start making a difference to your cash flow today without selling a penny more in sales. Okay, well, I'm going to stop waffling on now. If you've not subscribed yet to my channel, please do so now, because I'd really love to see you again. And with that in mind, I will see you in the next video.